Most investors chase constant activity, thinking it builds wealth. But that habit destroys it. You react to every market headline, every hot tip, trading endlessly in hopes of beating the market. It feels productive, but it leads to losses. Warren Buffett has one principle that replaces overactivity with strategic wealth building. First, we'll break down why activity fails. Then, how to implement Buffett's approach for long-term gains. If you're serious about long-term growth, hit subscribe now. The habit of overactivity. The habit of overactivity means mistaking constant trading, market timing, and news chasing for real progress. You check prices daily, jump on trends, and make moves based on short-term noise. It seems smart, like you're in control, but it pulls you away from what actually grows wealth. Why does it fail? Overactivity leads you to buy high on hype and sell low in panic. When markets rally on excitement, you pile in at peak prices. Then fear hits during dips, and you exit too soon. Emotions override any solid plan. Transaction fees add up, eating into returns with every trade. Taxes from frequent selling compound the damage. What this means is your portfolio underperforms what a simple hold would deliver. Think about this principle. The average investor lags the market by several percentage points each year because of this behavior. Studies show it's often 4 or 5% annually. That gap turns into massive lost wealth over decades. If you start with $10,000, that underperformance could cost you hundreds of thousands by retirement. We all feel that urge to act when screens flash red or green. The pressure builds, friends share wins, headlines scream urgency. But reacting locks in mistakes. Now, let's break this down further. Overactivity ignores business fundamentals. You focus on price swings instead of company value. A stock drops 10%. You sell, missing the rebound if the business stays strong. It rises 20%. You buy more, chasing momentum that fades. Fees from brokers and platforms drain 1 to 2% per trade sometimes. Over a year, dozens of trades erase gains. Emotions amplify it. You trade on hope or fear, not analysis. Here's where most people mess up. They think sitting still means missing opportunities. But constant moves create costs without edge. Professional traders with tools still struggle to beat indexes long term. For you, it's worse without that infrastructure. The real impact hits compounding. Each bad trade disrupts the growth curve. Money that could double every 7 to 10 years stalls. To understand this better, consider a simple portfolio. You invest in quality stocks. Market volatility hits, up 30%, down 20%. Active traders buy the up, sell the down. Net result? Flat or loss after fees. Passive holders weather it, capturing full recovery. Overactivity sabotages your financial future by turning investors into gamblers. Now that you see the trap, let's examine Buffett's counter strategy. Buffett's principle of strategic inactivity. Buffett's principle centers on strategic inactivity. You invest in quality businesses, then hold them through all market noise. What this means is you treat stocks as ownership in real companies, not as ticker symbols to trade. Focus on the underlying value. Ignore the daily ups and downs. Why does this work? Time rewards patience. Compounding turns good investments into fortunes. Predicting short-term moves is impossible, even for pros. But quality businesses grow over decades. Their earnings compound. Share prices follow eventually. Overactivity disrupts this process. Strategic inactivity lets it run. Now, let's look at how to apply it. You need a clear process. Step 1. Select undervalued cash-generating companies. Look for businesses with strong moats, consistent profits, competitive advantages. Buy when the market undervalues them, not when hype drives prices up. Step 2. Ignore daily quotes. Set it and forget it. Check quarterly earnings, not minute-by-minute prices. This cuts emotional trades, frees you from noise. Step 3. Rebalance only when fundamentals change. If the business deteriorates, management shifts, competition rises, sell. Otherwise, hold. Add more if it gets cheaper. To understand this better, think of investing like planting a garden. You choose strong seeds. Water them consistently, but you don't dig them up daily to check roots. That kills growth. Patience lets them mature. Common pitfalls hit here. Volatility itches you to act. A 20% drop screams sell. But if the business is sound, it's a discount. We all feel that pull. The fix? Review your criteria up front. Stick to them. What I mean by that is, build a checklist. Does it generate cash? Strong balance sheet? Honest management? If yes, hold. Long term, this builds wealth. Buffett applied it at Berkshire Hathaway. Turned modest capital into enormous value. Through decades of holding great companies. The key takeaway here is patience compounds. Activity destroys. You shift from reacting to owning. Implement this today. Build generational wealth. Conclusion: replace overactivity with Buffett's strategic holding to capture compounding gains. Review your portfolio now. Cut unnecessary trades. Focus on business value. Comment your biggest activity mistake below. Subscribe for more wealth principles that build long-term security.